Hi everybody, this is James Tompkins. So what should the relevant cash flows be for the asset investment decision? Well, first of all, it'll help if you understand what I mean by the asset investment decision. There's a nugget on that. Basically, it's what a company spends its money on, its business plan. So, for example, did Boeing have to spend a bunch of money to develop the Dreamliner commercial aircraft? They did, right? And then you also have to understand what I mean by net present value, which is a type of analysis that is applied to the asset investment decision. And of course, all this can be found at my Corporate Finance Series playlist. So first of all, what I'm going to do is go through a few miscellaneous points as far as these relevant cash flows are concerned. And then I'll go through a very simple personal example. And then we'll say, all right, well, how is the world a little bit different when we add in some corporate considerations? So to date, what I've done with these nuggets and the lectures is I've just taken for granted, I've just applied some cash flows and said, hey, take my word for it for the asset investment decision. But the question is, well, what should these relevant cash flows be? So for example, when I make an asset investment decision, at least if I'm spending money to make money, then is my cash flow initially going to be positive or negative? Negative, right? And at what time period will I be spending that money? Well, if I'm making the decision right now, more or less, then presumably today, right? So here I have at time zero, minus $10,000. And then the question is, well, what do I put for all of these guys right here? Suppose this is a 5-year project. Well, suppose this is, I don't know, my lemonade stand. So I spend money on a lemonade stand. And then the question is, well, what am I going to hope will happen with that? Or what am I going to hope to produce? Well, presumably I hope to produce lemonade, right? And over the course of the year, hopefully I'll sell some lemonade, but then I'll have to pay my kids slave wages to sell it, and I'll have to buy the lemons, and so on and so forth, right? And so the question is, over the course of the life of this lemonade stand, or however long I keep it, what cash flows should I be putting there? So that's the goal today. So, like I said, I'm going to start off with a few miscellaneous comments. And so the first thing is, well, do I care about cash flows, or do I care about accounting profits? So if I have my lemonade stand and I have sales, and in fact we can go back to this slide and I subtract all of this stuff, I end up with net income. In other words, I end up with $70 of profits. Is the 70 the number that I should be using for this asset investment decision? Is the 70 the number I should be putting here, for example? And the answer is no, we care about cash flows. And why do you think that is? Well, suppose I had the top 10 accounting experts in the entire world, right? And they decide, you know what, we're each going to independently look at McDonald's, and we're going to ascertain or assess what McDonald's profits are. How many different answers do you think I'd get? Get 10, right? And I don't mean for illegal reasons, I mean totally legal, because when you do accounting, is there judgment involved? There is, right? They've got all these rules and so on and so forth. But if I hold up a dollar bill, is there anyone who's going to question about what that dollar is worth? No. Cash is cash, right? It's self-evident. And so, therefore, we care about cash flows. And what about incremental? And what do I mean by incremental? So, for example, do I want to look at McDonald's? If McDonald's is deciding to make an asset investment decision, maybe they're deciding to open a new store. Do I care about McDonald's cash flows as a whole, or do I care about the cash flows that are directly a result of that new store, and therefore incremental? Well, I'm making a decision about the new store, right? And so therefore, I care about the cash flows that are created and lost because of the new store. So far we care about cash flows, and it's incremental. Now, let's say I finance this asset with both debt and equity. Should I deduct the interest? In other words, let's say here's my asset investment decision. So, minus 10,000 cash outflow today, and in the course of the next year I have sales and all this kind of stuff. And the question is, because I finance some of it with debt, will I owe interest? I will. So imagine this is the interest I owe. So the question is this part of the relevant cash flow? Well, we're going to find out it's not for a couple of different reasons. One's intuitive and the other has a little bit more depth. The intuitive one is on this side right here. What kind of decision is that? That's an asset investment decision, right? Or capital budgeting, as the textbooks call it. But what about on this side? What kind of decision is that? Well, this is the capital structure or the financing decision. Now, does the financing decision mean, well, I wonder if I'll raise money or not? No, because if you're going to spend money on something, do you have to raise money on something? You do, right? So it's not, I wonder if I'll raise money. The financing or the capital structure decision is, given that I raise money, how will I structure it? Will I have no debt and all equity? Will I have 8,000 in debt and 2,000 equity? Or, as I show here, 4,000 in debt and 6,000 equity? And so the point is that right here, we're making an asset investment decision. And the fact that I can still invest in my lemonade stand or whatever, but finance it in many different ways. Does that suggest that, at least to some degree, that these two decisions are separable? It does, right? And so, as soon as I start deducting interest right here, well, to what decision is that relevant? The financing decision or the asset investment decision? Well, it's relevant to the financing decision, right? Because why am I subtracting interest? Well, because in the financing decision, I made a decision to include debt. And so therefore, since this is an asset investment decision, then I would not want to subtract interest. Why? I do not want to mix up asset investment decision stuff with capital structure or financing decision stuff. So one answer is no. It's an operational decision. We're concerned with operational cash flows. But we can actually go a little bit deeper than that, and if you really want to get in depth, you'll have to watch the discount rate for the asset investment decision. But it's unfair to say that, well, does that mean that these costs are irrelevant to the asset investment decision? And no, they're not. But what about the equity cost? I mean, do the equity holders, are they going to say, hey, you can have my money for free, or will they also require some sort of return, like the debt holders want interest? They will, right? And so it turns out, or what you'll find out if you watch the discount rate for the asset investment decision, is that the cost of debt and the cost of equity, well, that's going to be incorporated into the discount rate when you apply that to the relevant cash flows. And so if you subtracted interest and you included it in the discount rate when you did, say, a net present value analysis, would that be like double counting? It would, right? And so therefore, when it comes to the relevant cash flows for the asset investment decision, when you're doing stuff like net present value analysis and so on and so forth, you do not subtract interest. Two quick reasons. One, it's an operational decision, and you'd be mixing up financing decision cash flows. And number two, you'd be double counting, because both the cost of debt and the cost of equity is included in the discount rate, as you will find out with greater depth from the discount rate for the asset investment decision lecture. So what else? Well, do we care about after-tax cash flows or before-tax cash flows? Well, suppose on that cash flow timeline diagram I had all right, the company's going to get, say, $1,000, but $300 belongs to the government. Well, when the company's making this decision, what do they care about? Do they care about what they get in the end, or do they want to be mixing up what they get with what the government gets? Well, they care about what they get, right? And so what's relevant, before or after tax cash flows? Well, therefore, after tax cash flows. Now, what about changes in working capital? Well, do you know what I mean by working capital? It's an accounting term, right? Working capital literally means current assets minus current liabilities. A current liability is what? Something that is due within a year, like, for example, short-term debt. And a current asset is what? Current asset is a liquid asset. Is that a short-term asset? Some sort of asset that you get within a year? No, it's a liquid asset. What do I mean by liquid? Well, it's something that's easily convertible into cash. That's just part of it. Easily convertible into cash at fair market value. Not just easily convertible into cash. Because would you say my car is easily convertible into cash compared to, say, this pen? Probably not, right? I probably have to put an ad in the paper and so on and so forth. But what if I said, hey, I drove my car here today and you can have it for $20? You think that'd be pretty easy to sell at $20 just like that? It would, right? So a liquid asset or a current asset is one that's easily convertible into cash at fair market value. Includes things like inventory and accounts receivable and so forth. So the only point is with the relevant cash flows. Suppose I'm deciding, you know what, I have a grocery store and I want to double its size. And so when I double its size, maybe it's costing me $10,000, and that's going to take care of, you know, the building and so on and so forth. But because I double the size of my grocery store, am I now going to need more tillers with more cash in it? I am, right? And will I have more food on the shelves? I will, right? And so when I stock those shelves with food and when I have more tillers with cash, is that going to require an additional cash outlay to support all that? It will, right? So maybe my change in working capital, I'll just make something up, is $500. So would that be a cash inflow or outflow? That'd be an outflow, right? So that minus 500 would be a relevant cash flow. And then suppose 5 years later I decide to sell my grocery store. Well, that cash in the tillers and the extra food on the shelves, does that still have value? It does, right? Would it be exactly the same as 500? No. Now, I don't know why, but a lot of textbook questions, they'll act like, you know, the change in working capital at time zero is the same as the one when you sell your business or whatever. So, but I'll just make a number up. Maybe we get back, you know, 400 because we have to, the food is a going out of business sale or whatever. So the only point is that the change in working capital is another relevant cash flow. It's not just, you know, how much does the new building cost. Another point. Suppose we have time zero today and we're looking at continuing a decision, but we've already spent $10,000 on a project. And so the question is, well, when I'm making a decision about whether or not to continue, is this minus $10,000 relevant to that decision? Well, suppose that whether I've proceeded forward with this project or not, this minus $10,000 that I'd already spent was completely irrecoverable, meaning, you know, it was gone. It's what's called a sunk cost. Would it be relevant or irrelevant? Well, it would be irrelevant, right? Because it's gone. It doesn't matter whether you proceed or you don't proceed. And so therefore, if, and this is an if, you're talking about a sunk cost, then it's not relevant to the decision. In this example, all of these cash flows from time 0 moving forward, what would be relevant? I remember years ago in Texas, they were building this electron collider thing, and it was miles long, and the idea was to make two electrons or whatever collide into each other. And it was at a time when oil had gone down in price a lot, and the state of Texas depended upon oil revenue a lot. And every year they would ask, hey, should we continue with this collider thing? And would that be flawed thinking? It's incorrect thinking, or would that be sound thinking? Well, it'd be incorrect, right? To the extent that, there wasn't a big market for people who wanted to buy half-built electron collider systems. And so the point is that a sunk cost is not relevant. So when we put it all together, what we have is relevant cash flows is that they're incremental, after tax, and operational. So if we go back to that example, okay, where I put 10,000 in my lemonade stand, and I'm trying to figure out, well, what cash flows do I put on the timeline moving forward? Then let's say this is an income statement for a given year. Question is, well, what kind of adjustments would I make to obtain the relevant cash number that would go on that timeline? So first of all, would sales be relevant? Well, my lemon is it as a result of the lemonade stand that I'm selling lemonade? It is, right? What about the cost of goods sold? Well, sure, I'm going to have to, pay my kids to sell the lemonade and buy the lemons and so on and so forth. What about depreciation? Is depreciation something you physically fork out? It's not, right? Is it therefore cash flow? It's not, right? However, does it have an impact on cash flows? It does, right? It has an impact on taxes. As a result of depreciation, do we pay more taxes or fewer taxes? Fewer, right? I mean, that's the whole point of it. You get to deduct your tax bill. So for now, I'm going to include it, but later we'll make a cash adjustment. And I'm including it now just so we can figure out our taxes. So here we end up with earnings before interest and taxes. Will I subtract interest? I won't, right? This is an operational decision, not a financing decision. So at this point, do I need to figure out my taxes? Yeah, because do we want after-tax cash flows or before-tax cash flows? After tax, right? So what do I do to this number to figure out how much I pay in taxes? Well, what's my tax rate? It's 30%, right? So if I take 30% and multiply it by that number, I get 90. So now I have my operational after-tax profit. But is this a cash flow? It's not, right? What do I have to add back in to make it a cash flow? Well, I have to add back in my depreciation. And so now I have my operational after-tax cash flow. And that is the number, that's the relevant cash flow number that I would put along that timeline diagram. By the way, there's another way to skin this cat, okay, as far as the depreciation goes. And so the question is, with this depreciation, because I have $100 less of taxable income, is that going to save me in taxes? It is, right? I mean, let's do it the other way around. Imagine for some reason, whatever reason, I had $100 of additional taxable income and the tax rate was 30%. How much extra would I pay in taxes? Well, $30, right? But in this case, because of depreciation, I have $100 of less of taxable income. So how much is it going to save me in taxes? Well, $30, the amount that I'm allowed to reduce my taxable income by, multiplied by the tax rate. And because I save in taxes, is this a cash inflow or a cash outflow? It's a cash outflow. I mean, it's a cash inflow, sorry. It's a cash inflow. We're saving taxes. So therefore, you could think of this $30 as a depreciation tax shield, at least for that particular period. So basically what we could do is we could say, all right, well, let's forget about depreciation for now. And so here we have earnings before interest, taxes, and depreciation. And then I could apply my taxes to that, so 30% times that number. And then I have to, what else consider? What else do I have to consider? Well, the depreciation tax shield, right? Yeah, I'm saving $30. And so in the end, we get to the exact same number. So what I want to do now is go through a simple personal example just to illustrate the incremental concept. And let's say you're thinking of selling your old car and buying a new one. So imagine the old car, you could sell it today for $2,000, and gas and maintenance, if you kept it, would be $1,000 a year. And let's say it's dead after 5 years. It has no value whatsoever after 5 years. And suppose with the new car, you could buy it today for $10,000. Okay, so this is a relatively inexpensive new car. And maybe it gets better gas mileage and so on and so forth. So gas and maintenance is only $300 a year. And after 5 years, it has value of $5,000. And the question is, well, do we buy the new car or do we not? And so our goal is to figure out, well, what are the relevant cash flows that would go on the timeline for this decision? Now, an approach, and there's no law that says you have to do this, is you could basically sort these cash flows into time zero cash flows, stuff that happens just at the beginning, recurring cash flows, time 1 to 5, and then terminal cash flows, the ones that happen in the end. So why is this a logical approach? Well, is there stuff that only happens at time 0 that doesn't happen in the other time periods? There is, right? Is there stuff that's recurring that doesn't happen at time 0 or 5? There is, right? So this is just a logical way to do this. So what we'll do is we'll do it from the perspective of buying the new and selling the old. And so I'll begin with time 0. So what's relevant at time 0? Well, at time 0, am I buying the new car? I am, right? So would that be a cash inflow or outflow? Be a cash outflow, right? So minus 10,000. Now, if I buy the new, what am I going to do with the old? Well, I'm going to sell it, right? So would that be a cash inflow or outflow? Inflow, right? How much? Well, $2,000. So basically, at time 0, our relevant cash number would be minus $8,000. So now let's do the recurring. So if I buy the new, will I be operating the new? I will, right? And is that going to be cash inflow or outflow if I'm operating the new? An outflow, right? An outflow of how much? Well, 300, right? Now, if I'm operating the new, am I continuing to operate the old or am I no longer operating the old? Well, I'm no longer operating the old. And if I'm no longer operating the old, is that the equivalent of a cash inflow or outflow? Oh, that's like an inflow, right? And so basically, my recurring cash flows from time 1 to 5 would be 700. So at this point, my cash flow timeline diagram is basically looking like this, where I have minus 8,000 and then all 700s. So what else do we have left to do? Time 5, right? Well, what happens at time 5? Well, I'm going to sell the new for 5,000. So is that a cash inflow or outflow? Inflow, right? Is there anything else going on at time 5? No, because the old one's dead after 5 years anyway. So if I put it all together, I basically get something that looks like that. So if I were going to calculate an NPV to figure out whether or not this was a good idea or not for me to buy the new and sell the old, what else do I need? I need a discount rate, right? So if I just make one up, say 10%, in this example is the minus 8,000, is my annuity, If you look at my multiple cash flow lecture, you can gear up on that if that's not clear to you, and then single cash flow right here. So get minus 2242. And so therefore, based strictly on financial considerations, would you buy the new car or not? You wouldn't, right? Because you have negative NPV. Now you might buy it anyway, right? But if you bought it anyway, would it be for financial considerations or non-financial, things outside of the boundaries of finance? Be non-financial, right? I mean, maybe you like that new car smell, or hey, maybe you can pick up chicks or whatever, right? So it would be for non-financial considerations if you bought the new car. Now, in theory, what we could have done is we could have used two sets of, if you will, absolute cash flows, and then subtracted the difference. So, for example, if I sell the old car, are those all inflows? They are, right? I sell it here, I'm no longer operating it here, and I get $57.90. And if I buy the new, these are all cash outflows except for when I sell it at the end, I get minus 8032. So if I put them together, I get the exact same number, minus 2242. So that is a simple personal example. What I want to do now is look at additional corporate considerations, depreciation, which we've really already covered, the finance components called the depreciation tax shield. You can go to books and they'll talk to you about how to operate different tables, and I don't teach that because that's like it's rote. It's something you can, there's no logic to it. There's something you can just be taught or learn how to do just by instructions, if you will. There's no logic. And another thing is, well, what about when I sell something? Okay, sometimes there's going to be a capital gain involved, sometimes a capital loss, or what we call the after-tax salvage value. So that's what I want to talk about right now. So when a company buys an asset, as we've already discussed, can they depreciate it? They can, right? Well, suppose they buy it for $5,000 and they're able to depreciate it $1,000 per year for 5 years. So this is straight line. Every year they get to depreciate $1,000. But then 3 years later, let's say they decide to sell the asset and the tax rate is 30%. So $1,000 per year over 3 years, how much depreciation has happened so far? 3,000, right? So if I look at my original price, 5,000, my total depreciation, 3,000, and so the value of this asset, as far as the government is concerned, is 2,000. It's what we call the book value. So suppose that the company actually was able to sell it for 3. So in other words, more than what the government, for book purposes, have decided what it's worth. Then will this company have made a capital gain or a capital loss? Or capital gain, right? Because they actually sold it for 3. It was on the books for 2, and so a capital gain of 1,000. And so, at least in the United States, I don't know about the tax laws in various parts of the world, but when you have a capital gain, are you going to pay more taxes or fewer taxes? More, right? And if the tax rate's 30%, then how much more would you pay in taxes? Well, in this example, $300. And so would that therefore be a cash inflow or outflow? Well, that would be a cash outflow, right? You're paying extra taxes. And so, therefore, the relevant cash flow for the sale is, well, we've got these extra taxes to pay, but what's another relevant item? Well, what about the money you're getting for the sale? You're selling it for $3,000. Is that relevant? It is, right? And would that be a cash inflow or outflow? It would be an inflow, right? And so therefore the relevant number in this example at time 5, or whenever the time period was, would be 2,700. Now, remember that the government said, hey, as far as we're concerned, it's worth 2,000. Well, what if the company had only sold it for 1,000? Would they have had a capital gain or a capital loss? capital loss, right? So the government's saying, hey, as far as we're concerned, it's worth 2, but you only sold it for 1, so that's a capital loss. And so with a capital loss, if they pay more or fewer taxes, they pay fewer, right? You get to deduct it. I know there's tax loss carry forwards and the nuances. I'm not getting into all the accounting. So just in principle, there's the possibility, if you will, of paying fewer taxes. Well, how much less would you pay in taxes? Well, if you get to deduct this from your taxable income, then it would save you $300. So then what are the relevant cash flows if this were the case, if you sold this thing? Well, is this 300 relevant? What it saves you on taxes because you sold it? It is, right? What else is relevant? Well, what about how much you sold it for? Is that a cash inflow or outflow? It's an inflow, right? And so when we put it together, we get $1,300. So I hope this was useful for you, and I hope to see you at other nuggets or lectures. Take care. Bye-bye.